Welcome back everybody. Today we will speak about news that are coming from Apple and Disney. A lot of people have tried to downplay new iPhone release from Apple, and then there is a lot of hype about news that are coming from Disney. As you perhaps remember, I used to own both Disney and Apple stocks in the past. I don't own them now, but I'm still closely tracking what is happening around these companies. Because I think that they are great companies, they have great business products and future, and I'm greatly involved in everything that these companies are doing and can give you different perspective than you can see on other YouTube channels or articles in the media, which will help you to make your own decision if you should buy these stocks or not. But before we jump to those interesting news, let's check up my portfolio. In the last several days, my return year to date went up almost to 33%. But since the stock markets are going down in the last few days, it is now sitting at around 31%. But the biggest change is actually happened in structure of my portfolio. As you can see, almost 1/4 of my portfolio consists from cash right now. And last time I showed you my portfolio, last week actually, my cash position was below 10%, and now it is sitting right now at around 25%. So what did I do? What happened? Actually, I sold some of my positions. You can see on this screenshot actually that I sold 20 stocks of JP Morgan, and I even realized 4% loss on this investment. I did it just because S&P 500 went all the way up to 3,500. My year-to-date return was 33%, and elections are coming soon. My cash position was really low. I simply wanted to raise some cash, that's all. I didn't expect JP Morgan to deliver bad quarterly result, and few days after I sold it, JP Morgan actually did report really decent results, but stocks sold anyway for a few percentage points. So actually I did good in the short term, and I actually sold my Alibaba shares yesterday. And since I sold them, they were tanking. I think they have sold off for around 6% since I sold them 24 hours ago. I bought them in August, and in only 2 months I realized over 20% return. So I did really good on those. Again, I expect Alibaba to do great in the future, but I simply went through all of my positions and I had to decide which one I want to sell based on current price, performance in the last several months, and I simply decided to cut my JP Morgan and Alibaba shares. But again, I will keep tracking these companies closely in the future and hopefully I will be able to buy these stocks again. Okay, let's move on to Apple. So as you all know, Apple unveiled new iPhone 12. There were 4 new 5G capable iPhone models. There is a lot of new interesting hardware incorporated in those iPhones. Yet again, I've noticed a lot of negative comments about this phone. A lot of people are saying Apple is lagging behind the market, there are already a lot of 5G phones on the market, there aren't any new innovations from Apple since Steve Jobs, this is nothing new, same old iPhone, etc. etc. And even I am not Apple's stockholder right now, I don't agree with these statements. Getting 5G phone is extremely important, because 5G is, after Apple has introduced it, finally becoming reality. Most of the world, except few Asian countries, were just reading about 5G networks and 5G technology. But now when Apple came out with its 5G phone, it's finally becoming reality. I think once Apple starts selling 5G phones, a lot of network providers will invest heavily to be able to compete with their competitors, providing 5G internet access. Then another thing, for the first time ever we have 5nm processor ever built into the phone, and it is A14 Bionic with 15 cores. So 5G is important. 5nm processor with 16 cores is important. But where the magic happens is actually when combining those two. Because iPhone 12, especially those with big screens, will be able to run extremely complex games, which we were used to play only on PlayStations, computers, and other playing consoles. Not only that, but for the first time they are offering mini iPhone with smaller screen. There is also night mode for the first time on mobile phones, for the selfie camera. So if you will be taking selfie shots in dark, your photo will look like you've been under 10 reflectors and perfect light. So there are a lot of new things. They are still innovating, they are still leading the world of smartphones. There is a lot of things that gets me excited as a gadget guy. So I don't agree with people who are downplaying this new device from Apple. It has more than enough innovations in it to encourage the beginning of the new iPhone cycle. Not only that, but you can see here, for example, that if you look back to the second quarter of the year, almost half of the smartphones shipped in China had 5G connectivity. And China is the world's largest 5G smartphone market. And then at the bottom you can see that around 20% of the iPhone upgrades will be coming from China region over the coming year. Asia, China in particular, but Asia overall is leading world when it comes to 5G internet. Japan, South Korea, China, Taiwan are years ahead of Europe and United States. So this upgrade was really needed for Apple to compete in China with its smartphone, but in Europe, in US, they basically don't have any competition. Users in Western world are used to Apple devices and were waiting for Apple before switching to 5G. Another interesting thing which I've noticed lately is that, for example, Apple used to introduce its new iPhone in September. And for the first time ever this year, they had their conference in September, but without iPhone. They introduced new software, they introduced new Apple Watch and its new features, they introduced some bundle of the services, they introduced a lot of different things, but there was no iPhone for the first time ever. Well, I personally liked it because up until a few years ago, Apple was mainly iPhone producer. And Apple was iPhone and iPhone was Apple. They were basically one trick pony. But since last several years, they have several other segments which are growing much faster than iPhone sales are, and they are switching from being hardware company to being software company. And to use their biggest conference of the year to introduce other segments of their company is sign to me that they are switching more and more from being mostly iPhone producer to being software company. I don't know if they did it intentionally or there were some complications around Apple production, so they were forced to move new iPhone presentation to October, but I personally liked it. It is showing that Apple is evolving, innovating, changing and moving forward. I'm not invested in Apple stock because I think they are quite pricey. Their trail P is 36, so I will be avoiding it for some more time, but again I'm watching it really closely. I think that everything that Apple is doing is really good, and I think there is bright future for them. But I would like to see substantial pullback in their stock price before investing in it. Okay, let's move on to Disney right now. So if you haven't heard, Mr. Leb is a hedge fund manager and his hedge fund invested more than $600 million in Disney stocks. And he sent a letter to Disney CEO Bob Chapek outlining his plan of how Disney's business should develop. He suggested a lot of things, but we will focus only on a few most important. So Mr. Leb believes that Disney can build a streaming business that eventually generates more revenue than cable TV and box office releases. So what he's suggesting is that Disney should permanently cut its dividend, which is worth around $3 billion a year, and invest that money in Disney Plus content budget. And there are actually a few reasons why I agree with Mr. Leb. The first reason is you can see here what are the budgets of Disney's biggest competitors. You can see that Netflix is investing more than $15 billion annually on producing streaming content. Amazon and Apple are investing around $6 billion per year, and at the bottom there is Disney Plus, which is investing around $2.5 billion. That is not much compared to their biggest competitors. Another reason is that most popular TV show on Disney Plus last month were Simpsons. Simpsons is a great TV show, but if that is your most important and most watched TV show, let me assume that you don't have many original great TV shows. Except Mandalorian, to be honest, I personally don't know for another great TV show from Disney Plus. And since there are a lot of subscription options, more and more users are cutting the costs and switching from one streaming service to another. I think Disney Plus is a great streaming service for family, kids, but I'm not sure how long will hype around Disney Plus be alive if they will not invest a lot of money in creating new and original TV shows. So if they want to grow their subscription numbers and if they want to keep up competing with Amazon and Netflix, I think they have to invest more money into streaming services. Another reason why I think that is extremely important is TV cable really is dying. You can see, for example, here that NBA Finals viewership were down 51% from the last year. National Hockey League Stanley Cup finals fell more than 60% compared to the last year. US Open declined 42%. Kentucky Derby lost more than 40% of its viewership. Similar numbers you can see at other segments of TV cable, which is biggest Disney business. So they really have to figure out what are their other options. And I agree that switching more and more to streaming is a great thing for the future of this company. And then a few days ago, Disney announced that they are reorganizing media entertainment around streaming. So the company will rearrange its media and entertainment division into a single organization responsible for content distribution, ad sales, and Disney Plus. So they are doing something about this. I don't know if it is because of the Mr. Leb or this is something that they were planning to do before his letter. I assume that is the case. But they are reorganizing their media business around streaming services. Again, I'm not sure how is that going to play out and what does that exactly means, but shares went up more than 3% once the news got announced, and investors in Disney are obviously cheering for this switch in the strategy. Here is what I think about this. Disney has several segments: media networks, parks, experiences and products, studio and entertainment, and then direct to consumer, which is streaming business. If the times would be normal, as they were, for example, last year, I would be invested in Disney because huge profits that they were generating from media network, parks, experiences and products, from their cruise lines, from their movies in movie theaters, would more than offset losses that they are generating right now in streaming business. Because you have to bear in mind that streaming business in 9 months of 2019 generated more than $1 billion of net loss. And this year, in first 9 months, even though their subscription base has been growing significantly, they managed to more than double their losses that they are generating in streaming business. So streaming business is burning more than $2 billion every 9 months, at least if you are watching quarterly earnings for the first 3 quarters of 2020. And the biggest fear that I have, which is turning me away from investing in Disney, is their parks are generating billions of losses per quarter. Studio entertainment profitability is declining rapidly. Streaming service is burning billions and billions dollars per year, and they really don't have a lot of things which are profitable right now. Of course, nobody could prepare for coronavirus. I'm not blaming Disney's management, but when I'm looking numbers of the Disney, I'm not so sure when they will start generating hefty profits as they used to in the past. And since I am a value investor who is looking for companies which are very profitable and which will be generating great amounts of free cash flow, which they can return to their shareholders, unfortunately Disney is not at this moment such a company. Of course, you can't watch past metrics, you have to look in the future. Those are fundamentals of investing. But looking at the future of Disney, I can assure you that streaming services will be generating billions and billions of losses for at least a couple of more years. And I'm not sure when are their cruise lines and parks going to open and how profitable are they going to be in the future. I think that we will have to wait for years and years before we can see, for example, 3, 4, 5, 6 or $8 billion of net income which parks generated in 2019. So taking everything into consideration, what Disney has been doing, what it will be doing and what it is doing right now, I will be staying aside and I will be watching what will happen with the Disney in the near term. Of course, I love Disney's products, I love what they're doing right now, but I am still not ready to invest in their stocks at these valuations. Perhaps I will miss a lot of gains in the future, that is completely possible, but since Disney is generating great amounts of losses, I simply cannot decide to invest my money in it right now. You can also check here in this video, which I made a few months ago about Disney, if you want to go more into deep in every single segment of Disney. Thank you for watching this video, hopefully you have gained some value in it, and see you next time.